Jim McCafferty is here. He's the Asia Research Product Manager at Royal Bank of Scotland. Jim, great of you to come in. Let's talk a little bit about, first of all, China. Okay. Now, 9% odd growth is not really a slowdown in my book.
Well, I think people are getting a little bit obsessed about the number. I think we're talking about 9.5, 9.6%. It's not really the absolute number that matters.
Our figure is 9.3 in our survey. Yeah.
Sure. I mean, I think what matters is the composition of GDP, how much is net exports, how much is domestic consumption, how much is government investment, and that's the key thing that people will be looking for.
Yeah, and we're looking at also what the Chinese authorities are doing. It's not quantitative growth, but qualitative growth. And how do you actually measure that?
Well, I think if you look at the 12th five-year plan, which was announced back in March, the government now is trying to ease back on some of the big infrastructure spending and put spending into social priorities, giving people more comfort in terms of healthcare, in terms of education, and actually allowing the consumer to have a bit more confidence about spending that very large pool of private sector savings.
Right, and of course, one of the things that everybody's concerned about is the interest rate hikes that we've had. Are they done?
We think there's going to be either one or two interest rate hikes before the end of this year, one in August and possibly one in the fourth quarter.
But would they move the reserve ratio instead?
Well, I think there's an issue about symmetry of interest rate hikes. Do we increase the lending rate and the deposit rate? And therefore the authorities have got some leeway on what they do there, so they may not have to touch the required reserve ratio.
Okay, but the inflation number is going to be looked at, of course, very closely, the one that we had over the weekend, 6.4% there. But the PPI was also the Producer Price Index, which of course acts as a guide as to inflation in the pipeline. That was also 7% plus.
Well, that's one of the issues which investors are having to deal with right now, and that really means that the sector selection is quite important. Looking at some of the costs that are going into these businesses, we're seeing margins coming under a bit of pressure in some sectors like food and beverage, for example, but there are other sectors which are potentially immune from inflation.
Right, such as?
Such as banks, we think. Banks have got the ability to expand their net interest margin. We've been seeing that quite a bit so far this year. There are issues potentially with local government funding vehicles which investors are concerned about, but that's one sector that we see as being relatively defensive against inflation. Right,
let's talk a little bit about Chinese equities too, because they do look cheap by most valuations, but there's always a reason for thinking things looking cheap here.
Well, I guess there are, and we've actually spent a lot of time with Chinese companies over the course of the last month. We had a big investor event back in London in the middle of June. We've just hosted an event here in Hong Kong with 50 Chinese corporates, and we've come away from these meetings feeling relatively positive. And I guess looking at valuation, it's important. Chinese equities on 10 times earnings through to 2012, you've got earnings growth of 16%. If you look at the US, you've got earnings growth which is less than that, and you're looking at a valuation premium of 40%. So it is cheap. You might say cheap for a reason, and of course Moody's report yesterday might be one reason for that.
Yeah, let's also just take a look at the other thing, which is the European debt contagion. How does that play out when it comes to this equity market there?
Well, we think that many Chinese companies are relatively insulated for that, and the ones that you will look to get exposed to are those with big domestic exposures. So some of the big Chinese consumer plays, for example, department stores have just got China exposure. You'd really look to see...
So you're looking at, again, this is the whole thing about qualitative growth as well, domestic-driven, indigenous growth.
Yeah, I think that's important. I mean, a number of Chinese companies have got big European exposure. You only have to look at M&A that's happening across the market with Chinese companies, for example, buying European car manufacturers. And that was unheard of 10 years ago, but companies now in China do have some material European exposure. And of course, exports has been a big driver of Chinese GDP and exports into markets like Europe. So now I think investors will be looking for the big domestic plays which are reliant on the domestic economy and the domestic consumer.
Jim, thanks so much for coming in. Jim McCafferty there from RBS.